Anand Shah joins us, head PMS and AIF investments with ICICI Prudential AMC. Anand, good morning. Thank you for joining us. Anand, are we likely to consolidate, looking at how the variable factors are moving on the macro front, on the valuation front, and on the earnings front?
I think obviously the macro, which is much talked about, coming off inflation and rising interest rates. I think the rest of the two is still manageable. I think rather positive in the sense that earnings will definitely get leg up, because with the higher inflation, with the rising interest rates, you will also look at global recovery, domestic recovery of the economy, which will push up the earnings. As far as the third leg, which is valuation you're talking about, I think again, if you dig deeper, there is quite a lot of heterogeneity in the sense that there is pockets of the economy or pockets of the market which are very expensive, but at the same time, there are laggards, there are industries which have been sort of not doing too well for the last 10 years, where we are seeing serious turnarounds, and still the valuations are fairly attractive.
What is your view on the way how some of the internet companies are planning to go public? Now there is a lot of excitement around Zomato, Paytm. Are you surprised? Or do you think this is a new world, and a new world will have new entrants, and you have to relook the way you value them?
I think these are emerging industries, I would say. In the very first place, we have to appreciate that this new age companies have created industries in itself. In the sense, when you speak of Uber and Ola, this is basically bringing taxis to your doorstep, and for taxis to bring customers to them. At the same time, you speak of Swiggy and Zomato, basically delivering anything and everything to your home, and for restaurants also to open up the entire opportunity of non-dining. So you were limited to the people who could come to your restaurants. Now you're opening up the entire market where you can deliver your foods. So if you're a best biryani cook in the town, you have the entire market available to you. So I think these are very, very new industries which are filling in some gaps. To that extent, this is still a very early stage, and a growth unlimited is what we can speak about. The second variable which we see in these industries is also dominance. And you can clearly see in most of these companies, you have either 1, 2, 3, 4 players. So I think these are two positives for them. I think what remains difficult for the traditional investor is lack of cash flows, lack of profits, and also these are again not getting a very easy ride. You will get new competition, you will get new players coming in, given that the market is still expanding rapidly. So I think you'll have to be very, very careful investing into these businesses. But most important, you need to have a really long-term horizon, because you're going to pay too much of a price. So too much of growth for many years to come would have sort of priced in. So yes, these are great businesses, and one needs to be very, very careful with the horizon with which they're investing in these businesses.
Anand, hi, good morning. What's your view on the overall infrastructure spend? Because despite the fact that we have endured this pandemic, we have seen the increased government spending, a lot of extensive scaling up as well in infrastructure projects. And now there seems to be that focus as well on clean energy and green initiatives that seems to have taken center stage.
Indeed, this is extremely interesting. I think if I see with a hindsight, a lot of good has happened, especially on the economic front in these difficult times that we have seen on the medical front, on the household front. I think apart from infrastructure, we are also seeing significant inroads into China plus one strategy. I think manufacturing is also picking up. We are seeing early green shoots of capex cycle coming back, especially in the private sector, in the pockets like steel and cement and others. So I think from a trend perspective, and I was talking about earnings growth before with Nikunj, I think we are seeing significant levers for earnings growth. I think one more point we need to highlight is the decarbonization in China. I think multiple manufacturing industries, which had almost a decade, 1.5 decades of stress emerging from China's dominance in manufacturing, I think we will see a reversal of that. We will see slowly, steadily, as the wage costs go up in China, as China's need to create jobs in manufacturing reduces, and most important, China's direction moving towards decarbonization, lower pollution, gives lot of runway of growth for quite a few manufacturing industries like chemicals, steel, in manufacturing, engineering goods. So apart from the infrastructure spend which government is doing, there are other factors which are also helping manufacturing sector in India. We're quite optimistic about the growth coming into manufacturing sector after a lag of a decade, 1.5 decades.
Which are the sectors that you believe that valuations look a little bit frothy, and hence one should look carefully, or perhaps you'd be circumspect on looking at those kind of companies or sectors? Would it be within the pharma or FMCG space?
Yes, indeed. What has happened in last decade or more, the B2C businesses had a good run. One, the Indian consumer continued to upgrade, continued to grow. Second, the commodity prices were fairly benign overall, so there was not too much of an inflation for the end consumer. Also, the manufacturing sector between commodities and the consumers was also under pressure. If you see, steel prices were sort of benign for almost a decade. We didn't see much inflation in the end car prices and others. So I think B2C businesses had a very good run, and no doubt about it that they have great ROEs, good customer franchise. To that extent, over last couple of years, particularly in last few years, we have seen rapid multiple increase also in these high quality businesses, which have good branch franchise. I think here is where we are seeing twin challenges. One, the valuations are very high. The other is, we believe these commodity prices which have moved up are here to stay for a while. They can come off a little bit, but the new normal will be far higher than what we have seen in the previous decade. Also, China's focus on decarbonization leads to manufacturing margins or the manufacturing profitability also moving up. So there would be some sort of pressure on the input side for these B2C businesses. At the same time, if you see consumer is not yet ready to take the price hikes, we are seeing a lot of pushback from consumers, given that what we have seen on the medical front, the expenditures are going up that front. And to that extent, there will be a period, couple of years, where the B2C businesses will have to absorb some of this inflation and let go of the margins to keep the volumes up. The good news there is obviously consolidation. I think what big change that has happened in last 15 to 16 months is also consolidation. So unorganized to organized also pick up. So that would be some relief in terms of volume growth rate, but we will see some margin pressures for these B2C businesses, including FMCG, which you spoke about. Whereas what we are seeing is manufacturing at the other end, which was under severe margin stress for last 10, 15 years because of the manufacturing dominance of China. I think we'll see some uptick in terms of their ability to pass on the input cost to the end consumers.
Sure. Anand, quite tempted to ask, the Zomato IPO opens tomorrow, and it's indeed a sky full of stars with the slew of India internet companies which are slated to hit the primary markets. Not just Zomato, next could be Paytm, there's Nykaa, there's Delivery, Flipkart, Policy Bazaar, Udaan, Car Trade, Byju's. I can just go on with the entire list. What is it that you're making of this emergence of the India internet players, the platform companies into the listed universe?
I think it's an entirely, as I before said, it's an entirely new, I would say, set of companies which are coming in. As I said, they're not really producing any product, largely services, but I think even within services, they're extremely tech-oriented service companies. So they've been sort of creating industries in itself in many of them, where those services didn't exist before. And the way they are going around, unlike in the previous 3 decades, where people would slowly and steadily grow business and make it big, the new tech companies actually burn a lot of money upfront and bring the customers on board. So I think for a listed space, or for the traditional fund managers who are quite comfortable looking at cash flows, looking at some discounted cash flows of the future, here we are not going to get those comforts. We are not going to see cash flows this year or maybe next few years in quite a few of those companies. And to that extent, this is, as I keep repeating, this is a very different set of companies which we are encountering. Erstwhile used to be largely a domain of private equity or the angel investors. I think growth is something which is extremely positive here. The industries are at a very early stage, and to that extent, growth can continue for many years to come. Again, the market dominance is more important. We'll have to evaluate each one of them, as they might be competing among the new age industries. Some of them might be competing with the old economy, brick and mortar businesses as well. Whether they have a strong, sustainable mode to keep the dominance on, because forget me not, I think there will be new companies which will come in. New age companies have huge cash flows, would also come into that business. So you will have emerging competition also. So do you have balance sheet strength to withstand new competition? Do you have a moat to continue to win and keep the dominance in the market? So there are many questions you will have to ask. And on top of it, you don't have cash flows comfort and the valuations comfort to invest into. So only thing that investors can do, and it will be very difficult for the retail investors to evaluate all this, but at ICICI Prudential, we have quite a few analysts and fund managers who are reading a lot and understanding a lot. We will have to have a fairly significantly long investment horizon in all these businesses. As the businesses open, the sector grows, the companies retains its dominance, and eventually the cash flows come through.
Sure. Also wanted to understand, Anand, where do you think that big virtuous investment cycle is going to come in from? Will it have to be a push from government capex, or do you think private spending can do it alone?
Good question. I think we are seeing that, and very clearly job creation is the most important ingredient in any virtuous cycle. And we saw that early on when tech and the infrastructure sectors did that for us in 2000 and 2007. I think we will have to see. So government infrastructure for sure is the first element, and that we have seen significant investments in the past few years, but I think we will see more this year and next year as well, as they've already stated. So one, it's a very big cock. The other one is residential and the commercial real estate. I think that's another sector which again we are seeing green shoots. Residential sales volumes are picking up. Salaries in IT sector is helping that as well. Salary growth in IT sector. So second big one is residential, and third, as you rightly said, is private sector capex, which will come and with a lot of lag. It's coming through because of one, government capex, and the residential sector picks up because that increases the demand for goods and services, which then in turn leads to the private sector capex. So I think today, as we see, these are the three elements from the domestic front. The fourth and big element is exports. And one of my colleagues was sharing it in the morning. We are seeing significant growth in exports. We are doing well now after a lag on goods, but I think services we've already been doing extremely well. So I think domestic infra spend, recovery in residential and commercial real estate investments, private sector capex, and the exports, all four can lead to some sort of virtuous cycle where you create jobs, which in turn creates needs for goods and services by those who get employed, which then again leads to investments into the capacities for manufacturing sector. I think the last element which I would like to add is India's competitiveness in manufacturing, especially not India. Everybody ex-China's competitiveness in manufacturing will increase significantly as China invests into pollution control, as China invests into decarbonization, and as China, the salary costs also go up. That also leads to some sort of, and that's what we are seeing, as I'm saying, even the goods exports is also picking up. So I think extremely right, time where we can, with little bit of push from government, which we are seeing in PLI, linked investments, lower corporate tax for new capex, we believe we can see good investments in manufacturing leading to some sort of virtuous.
Yeah, Anand is all anchors, single mat rakhna. Okay, let's get closing comments from you.
Yeah, so I think...
Are markets prepared for a third wave? God forbid if there is a third wave. God forbid if there is a third wave, will that derail the market again? Because markets in a sense have done rather well despite how strong the second wave was.
Indeed, I think no doubt about it that the good news is that we are all bracing for third wave unlike second wave. So the governments and the people at large are aware that there can be a third wave, which itself will make it a little less, it will be less, dangerous than what the second wave is. But if you observe from first wave to second wave, I think while the B2C businesses, the businesses which deal with the household got disrupted to some extent, manufacturing at large, B2B businesses continue to do well. So if I were to break down the markets into three, the businesses dependent on the global recovery, they have continued to do well, and they're actually doing very well as US, Europe, China, all three sort of come out of the pandemic as the vaccination rate is very high, and we are seeing early signs that vaccination is working. Second big part of the economy is the domestic recovery. We spoke about infra, we spoke about a little bit of manufacturing capex, but also quite a few industries in India are not as impacted because they are not into the last mile. Even some banking is not impacted. A lot of industries like ours, which is more digital, are not impacted. So I think within domestic also there are pockets of like telecom and others are really not impacted, and they will continue to do well. I think one need to watch out for the third wave can be really, difficult for already industries which are sort of late recovery pocket, as I put. The industries linked to retail, the industries linked to multiplexes, industries linked to travel, tourism. I think they are already under stress. And if, God forbid, we have a third wave, which is far more damning than the second wave, obviously, quite of these companies, they have raised equity. They are sort of covered from a cash flows point of view, as I emerge. But a lot of them in the unorganized sector who don't have an access to capital, both the bank capital as well as equity capital, it will be difficult for them. But as you see, it is from a percentage of market cap, listed market cap is a very small. And to that extent, I see from the market's point of view and the overall economic point of view, the impact of second wave was far lower than the first wave. And our take is the impact of third wave will be far lower than the second.